The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Inflation is back, or maybe it never actually went away. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. Welcome back. Good to see you.
Absolutely. And happy birthday, by the way.
Oh, my goodness. It's not my birthday. No, this is all a lie. It's not till April. All right, let's get a check on here where markets stand. You got the S&P down 0.2%, well off the lows of the session, though. Julian Emanuel over at Evercore saying buy the dip in the themes that you believe in, like AI, and the NASDAQ is up almost 0.2%. Romaine, just for some perspective, though, the selling in the bond market continues, yields up the most since last December, and the dollar yen also staging a really nice rally. So still those inflation cracks really cross asset delivering some moves.
And those inflation cracks, of course, the talk of the town. Price increases for car insurance, airfare, groceries, medicine, gas, housing, all contributing to a hot CPI report for January that did add further evidence that not only did disinflation reach stall speed, but the progress the Fed made on containing inflation, that may have officially reversed. Fed Chair Jay Powell acknowledging those price pressures, testifying on Capitol Hill today.
We're close, but not there on inflation. And you did see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress, but we're not quite there yet. So
progress, sure, but here's what he didn't say. That progress has been idle for months. The Fed's decision to start hiking rates in 2022 did indeed help knock core CPI down from a 40-year high of 6.6% to less than 5% by 2023. But then the Fed stopped raising rates and in 2024 started cutting. The result? Core CPI has been pinned between 3.2 and 3.4% for what is now 9 straight months. And what exactly is the Fed doing about it? Not much, according to Mohamed El-Arian.
This Fed has no strategic anchoring. It is a ridiculous sequence that we've had. There is no meaningful forward policy guidance coming from this Fed.
Now, the market reaction has been interesting. U.S. stocks did open lower, though they did quickly bounce off that support line of 6,000, recouping much of those losses. Not so much of a snapback yet on Treasury yields, as Alex was just saying. They spiked to their highest levels in a month and currently are stuck there, extending a sell-off in the benchmark 10-year to a 5th straight day. Interest rate swaps now showing traders expect just 1 quarter-point cut this year. That's down from 2 just yesterday.
All the way in December, too. Yeah. All right, let's get a little bit more detail. This is the ECAN function on the Bloomberg terminal. It really helps to break down the different inputs to overall CPI. The yellow bar is core services, the purple is core goods, then the red is energy, and then the blue is food. And what I find really interesting about this is the disinflationary trend that we saw back in 2024 is basically over in this last read. Maybe a little touch of a disinflationary trend when it comes to the core goods. But for the most part, everything else, energy and food, as well as services, is still rising. Now, albeit services inflation has come off the boil from what we saw back in 2024 in July. But still, we're right around 40-year highs. And any way you look at it, those prices appear sticky. Plus, Romaine, if the disinflation narrative is over, then what?
Then what? Let's pose that question to our first guest. Kicking us off to the close is Esther George, of course, former Kansas City Fed president. And Esther, you've had a lifetime really of doing this. You've seen these various inflationary cycles, these various economic cycles. Should we be worried about a potential resurgence in inflation, or is this just that normal sort of bumpy road down to what I guess most of us hope is going to be that 2% target?
Yeah, well, thank you for having me today. And I think you have to be worried about this inflation. Not because what we've seen so far tells us that there'll be a resurgence, but because this level of inflation has remained well above the Fed's target. And that, of course, is a principal job of the FOMC, is to make sure that inflation rate gets back to its 2% target in a timely way. And we've gone on some time now with inflation hanging out there a ways above that.
How dangerous is it, though? I mean, we still talk, at least if you take Powell's preferred measure, the core PCE. I mean, we're basically at around 3% on some of the headline CPI numbers. We're certainly in an area that I think a lot of people can live with, whether it's the economy, whether it's corporations, or whether it's the market. If the economy is healthy, as evidenced by consumer spending, as evidenced by the labor market, should we still be quibbling over 3.3% on core CPI?
Well, I think you do want to quibble over it because once an inflation psychology gets embedded in an economy, you begin to see inflation expectations change. And it's one of the things that would have my attention right now is the Fed has been able to rely on well-anchored inflation expectations over the course of this post-pandemic period. But if you look at recent prints, you will see that those are beginning to drift up. And even consumer expectations are beginning to signal expectations of future inflation. And that's why, in addition to the Fed's own credibility, you want to anchor that inflation at the Fed's stated 2% target.
A lot is being made, though, Esther, on seasonality, and there's January seasonality, sort of post-vacation movement there. You also had the LA wildfires, et cetera. Do you buy the seasonality argument?
Well, there's always an element there that you have to take note of. But I think what's particularly important right now is this isn't just a one-off data print. You have now seen a succession of reports that are telling us that inflation is hanging in there in the 3% range. And even though that's not the Fed's preferred indicator when they are making decisions, the truth is CPI tells us something because so many contracts in our economy are based off of this. And so it's not to be ignored, I think, and just dismissed at this point. And I'd be paying very careful attention to the numbers we've seen come in.
Now, clearly at the Fed, you guys look at PCE versus CPI. So is there a level for PCE that you guys used to talk about? OK, that's a hurdle for, say, talking about hikes.
Well, I don't think there was a particular level to talk about hikes, because what you're always trying to figure out is that core level telling us something. Is it the headline, which can be volatile, as people know, with food and energy cost? I think what we've seen over the past few years, though, is something quite different. This is really telling us that there is real inflation in the economy. And the Fed has been quite clear, as I think they have to be, that they will not be satisfied that they have achieved their mandate until they get back to 2% on a sustainable basis. And so there's more work to do here, clearly.
Are you generally, though, satisfied with the communication that we're getting out of the Fed, whether it's coming directly from Powell or from some of the other FOMC members? Is that helping?
Well, the markets, I think, have already begun to take note that this idea of a steady pace of rate cuts is not likely to happen. And of course, with 100 basis points of cuts last year, the most recent one in December, those expectations are beginning to shift. And I hear that in the communications from the Fed, which is to say, we are not going to be moving. We have time. We want to watch and see what happens with the data. And this is true not only for inflation, but you see a number of other policy implications coming down the road as the new administration begins to look at various levers they have for the economy.
But does the Fed have that luxury of just waiting and seeing? And they've been waiting and seeing for a while now. And we played some comments earlier from Mohamed El-Arian, and he gave an interview on Bloomberg Television where he talked about, in his words, what he sees as a lack of strategic vision on the part of the Fed. This idea of just wait for the whites of the eyes before you shoot. And he seems, and certain folks in the market also seem to think that maybe the Fed should be a bit more proactive.
So I think the Fed is certainly going to have to be talking about this. And if you listen to their language, they continue to refer to current interest rates, even at that 4.25%, 4.5%, to be in restrictive territory. Some refer to it as meaningfully restrictive. Some have said maybe it's getting close to neutral. And so I suspect at their upcoming meeting, this has to be a real point of discussion, is really narrowing in on where they think they are and how they will communicate what their stance is going to be relative to the objective that's in front of them.
Esther, is it at all confusing as to why it seems like the feed through from rates from monetary policy to the real economy has been somewhat stymied?
Yeah, I think that's been interesting to see whether the transmission of policy has changed. And you can look at some of the reasons why that might be. For example, just look at a market that tends to get hit directly in real estate, and particularly residential real estate. When most of the mortgage holders have locked in low rates, it will make the transmission of that policy different this time and slower. You also see that, I think, when you look at services. A services economy has a different traction, I would guess, as it relates to that policy transmission. So it is a challenge for the Fed coming off the pandemic, coming off the supply chain issues that were complicating their analysis, to really understand that transmission. I think the risk, of course, and one they must be very mindful of, is that waiting too long carries important risk until they bring that inflation rate back down.
Esther, it was a true pleasure to get your perspective. Thank you so much, Esther George, former president and chief executive of the Federal Reserve Bank of Kansas City. All right, we're seeing a sell-off in treasuries continue. You're having yields up by about 9 basis points, up for 5 straight days. The biggest sell-off, really, for the treasury market since December. That consumer price index rising the most since August of 2023. Joining us now is Gargi Chaudhuri. She's a chief investment and portfolio strategist for the Americas over at BlackRock. Gargi, Jay Powell today in his testimony to the House Financial Services Committee said the risk of higher inflation is priced into the long rates. Do you think that's true?
Good afternoon. Good to be here, Alex and Romaine. So I definitely think, as you were pointing out earlier, we've seen that move higher in the bond markets today. I think particularly if we look at what inflation break-evens have done, so really looking at expectations of inflation as priced by the market and the TIPS market, you do see some of that, especially when you look at the 5-year sector, for example, just over the last month or so, that massive break-even widening that has come through. So yes, there is certainly some pricing in of inflation expectations here. And we're also seeing that, obviously, with the front end of the Fed funds rate getting priced out, with the first rate cut moved out all the way till the end of the year.
When we saw a similar rally to this, a sell-off in the Treasury market earlier this year, as well back in late spring of last year, obviously the equity market also sold off. Do you feel like we could be in a similar situation this time?
You know, so obviously we're seeing a little bit of weakness in the equity market so far. Look, I think what's really important for the equity market here are a couple of things. Number one, continuing to see earnings growth come through. And obviously, we have seen about 70% of earnings come through so far. We're beating what was quite high expectations coming into this quarter. What we have to see is for Q1 and the entirety of 2025, if earnings expectations can match that, call it 12% growth that is expected. So that's really important. And obviously, we're going to keep an eye on that. Number two, I would say where in equities you're focused on is really very important, especially when rates are high. So we've continued to talk about, and in this show with you, we've continued to talk about that focus on quality, that focus on large cap and quality, and maybe even large cap value and financials away from small caps. And I think, again, in this particular environment where we're going to be higher for longer, away from small cap into quality, really important theme to keep in mind for listeners.
So, Gargi, though, with regards to those large cap names and the earnings that we got out of them, and we've gotten through most of the large cap companies so far, were you encouraged by this earnings season? Not just what they reported for the fourth quarter, but the guidance and commentary they gave for 2025?
Absolutely. I think, we obviously had a little hiccup in the midst of earnings season when we had the DeepSeek news, which feels like it was 4 months ago, but it wasn't. And in the midst of that, what we also saw was when some of the large cap names reported, there was more spending on CapEx. So that fear that had gripped the market for about 1.5 days around the AI CapEx just going away, we recognize realized that that is no longer the case. We all learned the terms Jevons paradox, and we learned that actually, if anything, there's going to be broad-based adoption of AI. And what we saw investors do actually in ETFs is pile into IGV, which is that expanded text software names, because again, it focuses on the adopters of AI. So I think, yes, a little bit of encouragement. We're not, AI still remains a trend that is going to drive markets. And I also think that so far, the growth in the economy, and we saw the Q4 numbers, the expectations of Q1 are strong, that's going to be really important too.
Yeah, it's funny. We're all talking about Jevons paradox, and I'm an expert on that. I had never heard of it 2 weeks ago. But
we didn't know those words a month ago.
But it gets to this idea, though, too, that if we do start to see a material tamp down in the costs to implement some of these AI tools and some of these AI strategies, where are the beneficiaries? Because that's not necessarily an NVIDIA, Microsoft story. I would think that would benefit some of those second-tier companies.
Absolutely. And some of our fundamental equity PMs are talking about exactly that. So the one thing that we've been telling clients is this is a time, especially if you are looking at the AI trade, is to be quite active around it, because the beneficiaries are going to, from the enablers to the adopters, that's going to move very, very swiftly. All of these days, we were talking a lot about the power and infrastructure build out that is absolutely going to be needed for AI. That's certainly a story that we're going to hear from. But more and more, it's going to maybe be around the software names. And we think that being active around the AI innovation theme with tickers such as BAI is really important in this environment. And I would also underscore how much this changes, the lower cost changes the adaptability, the adoption of AI for everyone at a lower cost.
So, Gargi, I wonder in the middle of all of this, though, how much is still being diverted to those money market funds and straight up cash, what you guys are seeing? Because we're all making a case for why we want to buy certain areas of the market and for when and what. And I'm just wondering how many people are just sitting hanging out.
As you, I'm sure, know, as we saw last year was an incredible year for markets, for fund of flows into ETFs, in fixed income, in equities. But what had the largest amount of inflows, over $1 trillion, was actually into money market funds. Mm-hmm. And frankly, some of that is just asset allocation. You have rates at 4.375%, and people feel very comfortable with that. And we have some amazing products that allow investors to do that, to clip that coupon. At the same time, we also think that we've gotten away from some of the uncertainties that were very prevalent. So perhaps some people were concerned around what elections would bring. And now that that uncertainty is away from us, maybe they get a little bit emboldened to step out of cash, maybe not all the way into equity markets, but really seek the income in the fixed income market. You talked a little bit earlier about rates moving higher. Mm-hmm. What a great opportunity to lock in yields with BINC, which gives you about 6% with very little duration and a lot of carry.
All right, Gargi, always a wonderful conversation. Gargi Chaudhuri there, Chief Investment and Portfolio Strategist for the Americas over at BlackRock, as we continue to count you down to those closing bells. A little less than 45 minutes to go, and, well, some big earnings after the bell. Maybe out of Robinhood. Things are looking good under the hood, so we're told, as we're expected to receive revenue almost double in the most recent quarter. A preview of what to expect. That's coming up next in our top calls right here on Bloomberg. All right, time now for our top calls. Big movers on the back of analyst recommendations. And we're going to start today with Lucid. New coverage of the EV maker over at Benchmark, starting with a buy and a $5 price target. The analyst saying Lucid is well positioned to achieve significant share, citing its technology, balance sheet, and that Saudi investment. He also expects Lucid to ramp up domestic EV production this year and further accelerate into 2027. Shares up 6%. Next, CRISPR Therapeutics raised a hold from sell over at TD Cowen. The analyst now sees a catalyst-rich year ahead for the gene editing company. This after posting better than expected fourth quarter results. However, his caution over management and the launch of that drug for sickle cell disease, just one of the factors keeping them from going all the way to a buy. Nevertheless, the share is getting a nice bid on the day, up about 8%. And finally, NXP Semiconductors, an upgrade to overweight at Morgan Stanley for the chip and electronics company. Analyst Joseph Moore sees cyclical and secular tailwinds aligning and setting NXP to this year outgrow peers serving the automotive industry. Moore also liking the structural improvements made to the company's business model. Shares at NXP up 4% on the day, and those are some of our top calls. We want to pivot now to some of the big earnings that we're getting after the bell, and that includes Robinhood. The market trading platform expected to report a big boost in revenue after enthusiasm for crypto trading carried on well after the U.S. election. John Tadaro joins us right now, senior research analyst at Needham. He's got a buy rating on the shares. All right, let's start with the revenue side. Expectations are high, $933 million in the most recent quarter, John. That's almost double what we saw in the previous quarter. Where are those gains coming from?
Yeah, a large part of it is crypto. So crypto did pick up a ton in Q4. November was a super strong month. December, that should be strong as well. So crypto did a lot of the heavy lifting. Equities have been strong as well. Options have been strong. So all three segments, we actually have growth into Q4. So Q4 should be a monster quarter for Robinhood.
How does this continue? I mean, just taking a look at the estimates, we're looking at a crypto business that, if analysts are right, is going to be basically about a third of their revenue for the most recent quarter. Is that sustainable into Q1 and beyond?
That's a good question. And that's where, I think we start to have some concern. So what's happened in the underlying crypto market, even though Bitcoin's doing well, it's at 97K, a lot of the altcoins have actually crashed pretty hard. And some of those are what I would call retail darling cryptocurrencies. And that's the meme coins that you've likely heard a lot about over the last couple months. Many of those meme coins are down 75, 80%. So typically what happens on a crash in some of these altcoins, it does lead to lower retail volumes as some of that retail activity gets flushed out. They take a breather, they stay sidelined for a little bit. So because of that, we actually are becoming a little bit more cautious on Q1. The back half of the year, you could see a pickup again. There's likely to be a lot more positive regulation to come out on crypto. But to your point, yeah, we do start to become concerned into Q1. A lot of red hot activity in crypto, and you're already starting to see some of that pull back.
To that point, John, what's the correlation? Is crypto trading on Robinhood moving more with, say, the macro environment and legislation, or is it a risk-on, risk-off thing right now?
Mostly risk-on, risk-off. And then there's pockets of activity that I would say, quite frankly, have nothing to do with macro. So some of these meme coins, there can just be momentum in certain retail pockets, activity around certain influencers that can get attention. Dave Portnoy recently had some. So that is what drives some of these isolated pockets of activity in some of the retail altcoins. But broadly, if you look at Bitcoin, that is going to be more macro-based. We still view most of the crypto ecosystem as risk on. So in environments where you want to take risk, crypto broadly does well. So anything like interest rate cuts like that gets it going. And then on vice versa, rates higher for longer, that's going to cool off crypto some.
What's your expectation for Robinhood, and that if growth kind of peters out, if we don't get more rate cuts, is there a direct correlation between that sort of murky economic backdrop to actual flows and trading on Robinhood?
We think there is, and certainly on the crypto side, equities have been a little bit stronger, and there's been a number of products that Robinhood has launched. So you are going to just gain some market share from the new products, and we think Robinhood has done a really good job of launching new products. That being said, you do need the pie to still grow overall. And for crypto, it's definitely sensitive to interest rates. So interest rates higher for longer, that's going to shrink the crypto pie, even if Robinhood's able to take more share. And then likewise on the retail equity side as well. You want to ideally get back to an environment that you saw in 2021, where there was a lot of retail activity across assets. And the big question is, do you need interest rate cuts to get back there?
Just real quickly, John, only have about 30 seconds left here, but what is sort of the broad long-term strategy? There's been a lot of chatter about this idea of Robinhood's move into other areas, not just investing directly, but maybe even kind of on the fringes of, I guess, what we consider sports gaming. But the idea of trying to make this app sort of everything for everybody who wants to invest, bet, or do anything even remotely related.
Yeah, and I think they're moving closer to that. They've done a really good job of becoming kind of this one-stop shop for financial services that starts to butt up to sports betting and some of these event-based contract betting as well. So there's some adjacent verticals Robinhood can certainly move into. They moved into credit cards. So they've done a lot on the broader fintech side of becoming a one-stop shop. There's a lot of crypto products they can still offer, and we think they are going to get to that.
All right, John, really appreciate it. Great stuff. Thanks a lot, John Tadaro over at Needham. Thank you very much. All right, coming up, how President Trump's relentless tariff threats are impacting corporations. Our conversation with Kevin Kajiwara, president of Teneo.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Alex Steele. The real action, Romaine, we're seeing today happens to be in the rates market.
Yes.
Sure, the equities are well off the lows of the session, but nonetheless, it really is the bond market. Jay Powell earlier today saying that should rates move on tariffs, he was asked that question, should they? And he said, yeah, it's possible. We could, but he doesn't know.
Yeah, well, we saw that in the last minutes. Remember, I mean, there was obviously some clear discussion among some of the members about trying to sort of put the prospect of tariffs into their longer-term economic and inflation targets, and I think he kind of threw them a bone. Of course, he doesn't want to sort of go there.
Exactly, and you were just at a supply chain conference.
Yeah,
so talk about uncertainty and lack of clarity.
Yeah, I was at this Manifest conference out in Vegas, and so it's all these supply chain chiefs, and of course, the big topic is, of course, trade, tariffs, and how you navigate that. Probably the most interesting thing is they're less worried about China, because most of them pivoted away from China after the last trade war. You remember that, right? I don't know how old you were back then. You know, plus the pandemic. So now they're more worried about where this goes next, right? Once you start tariffing Canada, Mexico, do you come after some of the Central American countries or the Southeast Asian countries where some of these productions and warehousings have moved? Then it becomes much more of an issue for them.
Did you get a sense as to what the strategy was?
The strategy was actually to wait. I mean, that was the other thing. Most people were saying, look, we're not going to react to this just yet. It's almost like the Fed. We criticize the Fed. Oh, you should be proactive. Most of these companies saying, we can't really afford to be proactive. That's too costly, because if Trump says, I'm going to do this today, and then he delays it a month or maybe rescinds it 2 months later, then you're just going to be left holding the bag.
And perfect segue to someone who deals with this on a day-to-day basis with their clients, Kevin Kajiwara, co-president of political risk advisory over at Teneo. So, Kevin, picking up on that point, what's the biggest question that you're getting right now, and what's your biggest response?
Well, Alex, I mean, as you know, at Teneo, we are talking to sort of Fortune 100 CEOs every day. And part of this is kind of very, very typical, right? On the one hand, it's very typical that you're trying to adjust to a new administration. There's always adjustments to make. And because Donald Trump had been president before, because he's kind of uniquely transparent in some ways, I think a lot of scenario planning went into this, and there was a lot of preparation done. Now, in the event, things have changed a little bit. The sheer velocity, there have been things that have happened that weren't necessarily expected, the priorities, some of the ordering of it all. And I think that what's happening is they're trying to discern, in a way, where's the signal, where's the noise. That's very, very typical. On the other hand, when they do kind of take a chance to step up and take some air, or more importantly, I've been talking to boards more recently, and the question is, what does this actually all mean? Is the fundamental underpinning of the global financial system and the global operating environment actually shifting in an irreversible way? And are we properly prepared and positioned for that? And
then you add in the other two parts, which would be deregulation and lower taxes, right? And there's a sequencing part. If you do tariffs first and then you do the good stuff later, how do you manage that if you're, say, a CFO and you're trying to manage the situation? Do you get a sense as to what companies want in exchange for managing tariffs?
Well, look, I mean, I think the expectation was that this was going to be a pro-growth administration, and that was going to be evidenced by the continuation of the tax plan. It was going to be a lower red tape, lower regulatory environment, et cetera, and to unleash the animal spirits. And all of that may very well still be the case. The issue is that it's being backloaded right now. Front-loaded are the things that are more hindrances on the economy or potentially inflationary. You point to the tariffs as an example. example, and we should get into that a little bit more because obviously, actually, only one tariff has been implemented. There's been a lot of news. A lot of this is getting kicked down the road, but how you calculate what the actual impact is going to be is very, very challenging. So right now, I think there's a lot of talk and a lot of expectation still about ultimately a more benign environment that will allow for kind of pro-growth policies to settle in and be realized in the economy. But at the moment, we had a higher than expected inflation print today. We don't know where rates are going to kind of wind up. And so you see, there's words on the one hand, but watch the action. Expectations were there was going to be an unleashing of corporate activity, of M&A and the like. And what have we seen in the first 2 months? Lowest M&A activity in a decade.
I am curious, though, too, about how fast companies can pivot. Let's say the tariffs do go into effect, once this 1 month reprieve is over. I mean, can they pivot? Are they prepared to pivot that quickly? Or is this going to be sort of a long, drawn-out process?
Well, I mean, look, in many cases, it's very, very dependent on the industry you're in. It's not easy to do when you're talking about massive amounts of, of sort of fixed capital in terms of factory, what your supply chain and where it comes from, and the like. So absolutely. But some have scenario planned well and have kind of prepared for this, and others, I think, and of course, if you are more exposed to the countries that are closer to the United States right now, specifically Canada and Mexico, a lot of the assumptions are tougher.
Well, I do want to talk about those companies that can't pivot that fast. I mean, when I was at this supply chain conference, you talk to people in the retail apparel industry, they can pivot a lot faster. It's a lot easier to move a warehouse and things like that. If you are a car maker, I mean, Jim Farley apparently, down in Washington now, trying to make the case for forestalling these tariffs. You can't just obviously build a new auto factory overnight on the other side of the border. You're basically stuck with whatever your supply chain is. So what is sort of the future for those companies if these tariffs do go into effect?
Well, I think, look, you've got to start to have a little bit more clarity on what the runway is going to look like 4 or 5 years down the road, because you're absolutely right. And even, by the way, in an environment like the one we're in right now, where you've got, say, 4%, sub 4% unemployment as an example. I mean, those factories are on the other side of the bridge in Ontario, not because it's fun to move the car 7 or 8 times across the border, but because it brings you the lowest cost, most efficient production, right? If you bring that production back to the United States with near full employment, you're going to have to displace somebody from doing something else that's productive for the economy and put them into that. That also that's inflationary unto itself, right? And not easy to do.
Do you get a sense that companies are willing to eat that cost, or is it going to be 100% pass through?
Well, I think, there's a near term and there's a longer term element of this. But if we look back to Trump 1.0, right, steel tariffs were put onto Canada and onto other trading partners. And what happened, right? The sort of deficit on steel trade narrowed. There was more production in the U.S., but U.S. steel producers were able to, enjoy better price flexibility at that point. So the car industry took a lot of the cost, and others who were using steel away from the savings that we're making on the steel front.
So wrap this all up for us. I mean, are these CEOs, and for that matter, the other executives and the boards, are they confident right now in the situation? I mean, I know there's a lot of chaos, there's a lot of noise here, but at its core, do they feel the confidence? And by that, I don't mean just, we're feeling good. I mean the confidence to continue investing, the confidence to continue hiring, and the confidence to continue growing.
I think that they are cautiously optimistic on that front, but I think they are taking a very, very careful look here because, by the way, even if you've got good access in Washington, and we see that there's a lot of CEOs going in and out of the White House and talking to other elements of the power matrix at the White House, but the reality of it is it's not just the U.S. that's moving here, right? China, Canada, Mexico, the Europeans, everybody else is taking action, and they're much better prepared this time around as well. You saw when we initially imposed tariffs on Canada 2 weekends ago, Canada had that list of retaliatory tariffs ready to go right away. There's a plan B in Mexico. We haven't actually seen it yet. The Europeans are coming up with a plan. China was able to respond essentially immediately. So, you're actually having to watch all of these dynamics, concurrently, which is challenging.
Challenging, and of course that's why folks like Teneo and you exist, of course, to help some of those companies through those challenging times. Kevin Kajiwara, co-president of Political Risk Advisory at Teneo as we continue to count you down to those closing bells. A look at two big movers on the day, a tale of two earnings reactions, DoorDash and Lyft. They're both our stocks of the hour. You're going to find out why when we come back. This is The Close on Bloomberg. All right, it's time now for our stock of the hour, and today we're taking a look at two stocks. We start, though, with Lyft. Those shares moving lower after the company gave a disappointing outlook for first quarter gross bookings, warning that cold weather might hurt demand. Now, Bloomberg's Jackie Davalos had a chance to catch up with the CEO of Lyft following the results. Here's what he had to say. Take a listen.
Demand isn't a problem. We've got demand like you wouldn't believe. In fact, if you look at last year, so we did about 800 million rides. That's crazy, 820 million rides, 16 billion in bookings, and we were profitable, and we have free cash flow of $766 million. So the business has never been stronger, and our service has never been better. We're picking you up a minute faster, 30 seconds faster than the other guys. I don't even want to say their name. But what we're also seeing is a little bit of lower pricing, a little bit. It's not something that we've super focused on, but I think maybe the other guys are trying to sort of compete in that way. Maybe it's something like that going on. So we decided to be a little bit conservative and just sort of call it like we saw it.
You mentioned that you did have to pull that pricing lever in December, though, and some analysts pointed it out in their notes this morning that they're concerned that this strategy, bringing prices down to compete with Uber, could erode the profits longer term. How would you respond to that? Yeah,
well, I'd say it's the other way around. I would say that it was actually they started it type of thing, but really we're in a good position to respond because we've got, as I say, 45 million riders. We've got products like Price Lock that tend to increase frequency and so forth. So I felt great. And then if you look at the margins, which of course as people start to care about as prices come down, we've increased our Black and SUV. So these are sort of the premium modes that have a little bit higher margin by about 40% year on year. As I say, we're picking people up faster than ever, which is good for the economics.
Well, a somewhat optimistic sort of commentary there by the CEO, but the numbers really weren't that optimistic. And it wasn't just about this total idea of growth. It was the fact that there were a lot of price pressures. There were in a lot of price competition with Uber, I assume the company you didn't want to mention by name. And that's eating away right now into margins, and that's the concern investors have going forward. Yeah, and he was saying that demand was really solid, but demand was also a little bit weak at the same time due to some cold weather. That stock just down 7%, also just below all of its moving averages as well. Flip side, you got DoorDash having an opposite reaction. Shares are up at about 3%. The largest food delivery service in the U.S. issued an outlook for orders in the first quarter that exceeded estimates. Technology's Jackie Davalos spoke to DoorDash's CFO about the growth that they've seen.
Dasher supply is in a very good spot. In fact, when I look at the Dasher demand, it's at a record high. Even over the last couple of years, when unemployment was at an all-time low, when the job market was pretty robust, Dashing demand was extremely high. Just goes to show you the power of the platform in terms of flexibility and accessibility. Millions of Dashers have earned over 18 billion of earnings just in the last year alone, and the state of Dashing looks extremely healthy. We are not seeing any impact at all. There's millions of Dashers on the platform. They continue to grow, and they continue to do more with us and earn more with us.
I really didn't know that dashing was a verb now.
I know. I guess you can make everything a verb.
I guess.
Yeah, sure.
Stock is doing really well.
Yes.
I have yet to meet a parent of a teenage child, though, or a college-age child that likes DoorDash because it's so expensive that they just keep doling it out. But I guess that's kind of the point. Thank you, teenagers.
We're kind of beholden to it. Have you used Wonder yet?
No.
Yeah, we've used
I
this.
walk out of the house and get my own food.
Oh, gosh, you're one of those snobs.
I mean, come on, it's around the corner. You live in New York. All right, we're 15 minutes to the closing bell here in the U.S. Jay Woods, Chief Global Strategist over at Freedom Capital Markets, will be joining us. This is Bloomberg.
I think you have to be worried about this inflation, not because what we've seen so far tells us that there'll be a resurgence, but because this level of inflation has remained well above the Fed's target. And we've gone on some time now with inflation hanging out there a ways above that.
Esther George, of course, the former president of the Kansas City Fed, and I think hanging out there might be an understatement. You kind of look at those numbers that Jay Powell talks about, whether it's that PCE number or you take core CPI this morning, we've basically where we've been now for at least 9 straight months. It's basically gone nowhere.
Yeah, exactly. And I was interested in sort of like what the hurdle rate is now for a hike. It's not inconceivable anymore that we could see that. We're hearing that from a lot of economists. I think it was Bank of America that said you got to have 3% PCE plus unanchored inflation expectations. Like, do we now get there?
Yeah. Well, it's interesting. So you talk about the market reaction. Obviously, the bond market reaction has been a little bit more severe. But what do you make of the reaction we see in equities? I mean, we opened significantly lower than where we are right now. And while we're still in the red, we've kind of recouped most of those losses.
Buy the dip. I mean, look at Meta. This is now 18 straight days of rallies for Meta. This is a record streak, and it's a record high on what? I mean, they had earnings, sure, but after that, I mean, it feels like it's still a buy the dip scenario. That's what Julian Emanuel said when it comes to some AI themes.
But the question is, what exactly are they buying? I mean, are they just going back to the big cash generators like, Meta, like an Apple, obviously an NVIDIA as well, or are they willing to take a chance on something else?
They're definitely not buying energy today, that's for sure.
Jay Woods joins us right now, Chief Global Strategist over at Freedom Capital Markets. Jay, what are you buying?
Well, they're rotating still, but they're buying stocks that have been beaten down. Some of the staples, Coca-Cola, McDonald's earlier this week, they're catching a bit. Hershey's a little bit of a bounce. So we're seeing some mean reversion in some stocks that have been beaten down. Energy already had that mean reversion. It's kind of at a midpoint where it should back off a little bit. But if you look at the top 6 sectors this year, they're all up 5% in, industrials, materials. Remember, they were getting killed at the end of the year. So we're not talking about those magnificent stocks, except for one. Yeah, that 18-day winning streak. I didn't have that on my bingo card, and it's still going even in this market right now. So this is a very confusing market. But when you look at it, the breadth had us scratching our heads not too long ago, and we're still seeing positive momentum, but it's starting to wane. And I thought today, and this is why I'm here, I'm like, we are rallying off of this number. We are not cutting rates anytime soon, even after the tweet this morning from the president saying it was time. Jerome Powell didn't do anything that could make us more nervous. So his testimony today on the Senate was something that kind of calmed us. But we're in this like no man's land with crazy headlines, but price actions dictating that it's okay. And sideways is a direction. I say that, and that's what we're doing.
Well, that's what I'm curious about, too. I mean, let's just focus on the Fed for 1 second here, because when you look at the CPI numbers today, obviously this gets to this idea that the Fed's not cutting anytime soon. Maybe even potentially they could hike if things get worse here. But can the market kind of live with that? Because I think about it, I mean, rates are basically where they've been now for months. I mean, and the market's done okay. Corporate earnings have held up in the face of relatively high rates, at least relative to zero bound that we were a couple of years ago here. So why am I to believe that even if we got a 25 basis point hike, that somehow that completely upends this market?
Well, I don't think we're going to get the hike yet, but to your point, we are holding up extremely well. This is becoming a new normal. We remember interest mortgage rates, 6%, 8%, and now we've been extending that for a long period of time, and people are starting to absorb it. It hasn't really translated to the housing market just yet, but the 10-year is the perfect example. The 10-year went up 100 bips when they started cutting rates, and what's happened? We are within 1.5% of an all-time high still. Earnings growth is still there. It's still projected to continue. And we have headwinds. Now it's 4X. First it was CapEx, and that's hurting some of the mega caps now. We're spending too much money. Amazon's spending $100 billion. Wow. But now when Coke and McDonald's report, they talked about growth overseas. Their growth here wasn't that strong, but overseas they're seeing expansion. So America may not be the best place to be right now, which is a crazy thing to say because I still think it is the best place to be over the long term. But short term right now, we're seeing resurgence in Chinese stocks, the internet stocks. David Tepper took a big position in Alibaba. That thing's just breaking out above its 200-day moving average on a weekly basis for the first time in a while. So that stock looks good. They report next week, and the K-Web risk-reward setups are favorable. So people are taking chances in areas where maybe they weren't earlier in the year.
So to that point, do you think that actually has legs? Because clearly you look at year to date, even European stocks are beating the S&P, which we would not have thought that was the case. Do we think this has legs, or the U.S. exceptionalism theme is still going to be reign here?
What it has is a resting period. It's a stabilization. It's a congestion period in this market. So what we're doing is we've digested 2 great years of price action. We're rotating into some of these smaller stocks that have been beaten down. We're looking for opportunities. People are being selective in what they're choosing. Yes, we have a meme stock almost once a week that comes out of nowhere. But for the most part, money is not leaving this market. The equal weight is outperforming the market cap weighted just slightly, but we haven't seen that in ages. 5 of the 7 Mag 7 are down. And Amazon's barely up. So.
I've been wondering if we need to rethink a Mag 7 situation. The more Meta keeps rallying. But before we let you go, we got the VIX. It's at 15. There's so much uncertainty. Does this surprise you?
Well, the VIX is what's kind of making me say, okay, we're not in this fearful mode. We're not in a panic. If we were going to hit one, the CPI number probably would have done it. And if Powell said anything to the contrary of what he said today, that would have been a wet blanket on this market. But right now, the market's been extremely resilient. I think all eyes are going to be focused in a week and a half on NVIDIA's earnings. That will really move things, knowing the weighting in that stock. Apple has come off its lows. So we're getting stabilization. I just don't know what the next catalyst is to take us higher. Still love the financial stocks. Seeing a lot of stocks lead us there. The Goldmans, the JP Morgans of the world. And now you look at Citigroup breaking out of a major base. If that can stay above 80, I love it. Bank of America following in its footsteps. So there's a lot of positivity there. And then M&A, we'll see what happens. SailPoint IPO next week. Things are picking up. So financials are still where you want to be. And that's not a bad leader in an overall bull market.
All right, Jay, always a great conversation. Jay Woods, Chief Global Strategist at Freedom Capital Markets, helping us count you down to those closing bells. Those bells just about 3 minutes away, Alex. And we talk about the complexion of, I don't know if you call this a sell-off, really. I mean, most stocks right now, at least on an aggregate basis, only down a fraction of a percent. And you have the NASDAQ 100 at least poking into the green.
Right. The only exception really, though, is energy getting pummeled here, about 2.6%. We are getting some headlines from the Trump administration about potentially resolving the war in Ukraine. And so that putting pressure on oil as you take some, sorry, I just kicked him under the table, as you take some geopolitical risk premium out of the market. I do.
Yeah. We talk about bright spots, if I can point out any bright spots. Sure. Biotech's doing well. Some healthcare stocks doing well. Chip stocks getting a bid, although a lot of that being led by NVIDIA and its high weighting.
And Meta. And Meta doing really well. Do you think we should rename the Mag 7? Do we need to think about it?
No. Can we rename Meta?
To Facebook? Yeah, okay.
We're moving closer to those closing bells. Stick with us. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside of fidgety Alex Steele, here to help take you through the closing bell, a global simulcast. It starts right now. Scarlett
because
Fu.
she's not used to you being there.
Scarlett Fu in the TV studio.
I
have a whole script here that I'm supposed to read, Carol Massar. You know, they deduct points away from me if I don't read the whole thing.
They don't.
That's Carol Massar, by the way, who introduced herself. Hey, Tim Stenovic. Nice to see you as well.
Good to see you. Welcome back.
As we welcome our audience across all of our Bloomberg platforms. We got lots to do. Let's get right to it. A lot of earnings coming after the bell, but a lot of action. Well, in the cash session today.
Yeah, kind of mellow, I feel like, in the equity trade. It's really been about the U.S. Treasury trade. Having said that, I am looking at the home builders down almost 2% here. That robust inflation print, CPI print, kind of diminishing the odds of a U.S. central bank rate cut. And, you think about how that plays into the mortgage market. So we see some pressure on that area.
Well, what happened to the pressure that we saw earlier in the session as a result of that hotter than expected CPI print? The NASDAQ 100 was down as much as 1.1%. Right now, it's higher. Did everybody, not get concerned about the price of?
Tim, that was 7.5 hours ago, Tim. What do you expect?
How resilient the equity market has
be nice
become.
To my co-host.
But to that point, Scarlett, a couple weeks ago we saw retail coming in, mom and pop buying the dip. Then we heard from Goldman Sachs that hedge funds were coming in and buying the dip. This just continues the theme that we've seen over the last couple weeks.
And it is a Wednesday. Remember, there's a story about how Wednesdays tend to be a little bit stronger for U.S. equities.
All right, we get the closing bells here in New York. A mixed bag, we'll call it here, though red across the screen for most of the major indices. But we should point out, where stocks open was a lot lower than where they're going to close today. The Dow Jones Industrial Average down more than 200 points, but that's only a drop of about 0.5%. The S&P 500 looks like it's going to close lower by roughly 0.25 percentage point right now at that 6,051 level. And we should point out the S&P tested that 6,000 level earlier in the session, and it bounced off it hard. A signal here that there are a lot of dip buyers looking for entry points. The NASDAQ composite is going to finish out the day in the green by only by a fraction of a percent. The NASDAQ 100 up about 0.1%. And the Russell 2000, that's your laggard, lower on the day by 20 points or 0.9%.
Yeah, with those little moves, it's always important to dig into the index, which is what we do right now. You've got about 344 names lower in the S&P 500. Scarlett, 158 to the upside.
All right, let's take a look at the IMAP. A lot of red on that screen. In fact, only 2 sectors finishing in the green, and that's even barely. Consumer staples up about 0.25%. Communications services basically unchanged. The big losers of the day are energy stocks. Alex mentioned it earlier, 2.7% lower with all 22 members in the red. Real estate investment trust and materials also down about 0.7% and 0.9%.
All right, guys, let's get to some of the individual gainers here. And you've got CVS, your number one gainer in the S&P 500, up about 15% here. Company reported adjusted profits for the fourth quarter that topped expectations. Also reported medical costs in health insurance unit that was better than the average analyst estimate. We had analysts viewing the overall results as better than feared, and Baird actually calling it a solid first step in the right direction. Do we want to do those earnings?
Yeah, let's just get squeeze in some earnings here. Good. Trade desk shares moving lower here in the after hours trade, down about almost 19% here. This is an advertising platform. Adjusted EPS did beat in the most recent quarter at 59 cents a share. Street was looking for 54 cents. Revenue, though, was light, 741 million. Street was looking for roughly about 760 million. The company also gave a forecast for first quarter revenue that appeared to come in a little bit light, 575 million. The Street on average looking for 581 and change. And just real quickly, we should point out their EBITDA forecast for the first quarter, adjusted EBITDA, 145 million. Street was looking for 192 million. So that's a big part of the reason you're seeing the shares down 21%.
Yeah, wow, that's a big hit to the downside. Waiting for some more earnings. I'm going to go back to another gainer. Gilead Sciences up 7.5%, a top gainer in both the S&P 500 and NASDAQ 100. The company coming out a big fourth quarter beat, gave 2025 guidance that analysts that beat analyst estimates, and it also highlighted continued demand for its top-selling HIV medicine. So really another big mover to the upside. And here's something, not an everyday name, Upstart Holdings. It is an $8 billion market cap. AI lending marketplace reported stronger than expected fourth quarter results, provided an upbeat outlook. Stock shot up 32% in
what
today's
is this,
session.
2021?
I should put
this was a meme stock.
It's up 44% year to date, 22%. Speaking of a meme stock, 22% of the float is shorted. So nonetheless, you had a bunch of analysts raising their price targets on it. So there you go.
Meta? You didn't do Meta, Carol?
I did not do Meta.
Okay, 18 days.
Do not
of gains.
judge me.
18 days of gains for Meta.
Let's just wait for the 19th day and do it tomorrow.
Thank you, Scarlett.
Okay. NVIDIA shares today falling by 1.25%. I did want to look at shares of NVIDIA because just over 2 weeks ago, we were talking about that DeepSeek news where NVIDIA fell 17% in a single day. It's still down more than 11% from that January record. Shares fell today after that underlying U.S. inflation report last month rose by the most since March. Lyft shares having a tough day, post earnings down 8%. First quarter gross bookings outlook came in below Wall Street expectations. Due to cold weather, it hurt demand not just for rides, but also for those bike rentals. The company did also announce its first share buyback, pledging to purchase up to $500 million. Stock did fall today by 7.8%. And finally, Zillow shares plunged more than 9% today. The company gave a revenue forecast for the first quarter that fell short of the average analyst estimate. The company does expect to generate positive net income on a GAAP basis this year. It's its first profitable year, going all the way back to 2012. At least 3 banks raised their price targets. We did speak to the company's CEO, Jeremy Waxman, earlier. He told us he's still very cautious on housing. Even if rates don't go down this year, it won't affect the company's outlook for the year. They also announced this Redfin partnership. I asked, are you going to buy Redfin? I mean, it's like a $1.1 billion company. Zillow's like $18, $19 billion in market cap. He said no plans to do it as of right now.
All right, just taking a look at the bond market here, because that's honestly, guys, where a lot of the action was and stayed. The belly of the curve seeing that sell-off. That's where we saw the most dramatic moves. We also had the 10-year auction that came at 1 p.m. It really wasn't that great. The bid-to-cover ratio was below that one-year average, the lowest in about 4 months. Really needed those higher yields to kick in to get demand. So now we sit at 4.62, you guys. We see the velocity of the move. At some point, does that then have a trickle-down effect when it comes to the equity market?
It's kind of interesting, too. We talk about the equity market reaction to that CPI report. And obviously the market did sort of recoup a lot of the losses, but then you look at what still finished down. Financials got hit, a lot of real estate and REITs got hit as well. Carol.
All right, let's get to Cisco. Let's go right to the fiscal year revenue. Everybody wanted to know about the outlook for this company. So fiscal year revenue, Cisco sees it at 56 to 56.5 billion. That is above what the street was expecting. They were looking for 55.3 to 56.3 billion. Seeing Cisco just up about 1%. It's boosting its quarterly dividend to 41 cents a share, which is what everybody was expecting. And here's a big deal. It boosts its buyback authorization by $15 billion. Investors tend to like that. It's up about 2% here in the aftermarket.
All right. Well, I'm looking at shares of Robinhood in the after hours right now. The company did report earnings just now. Shares of Robinhood higher by 8% as we speak. Fourth quarter crypto revenue coming in above estimates at $358 million. Fourth quarter net revenue beating estimates coming in at $1.01 billion. Fourth quarter EPS coming in at $1.01. Fourth quarter net deposits coming in above estimates at $16.1 billion. Also, their assets under custody in the fourth quarter beating estimates at $193 billion. Shares higher right now by 9%.
All right, let's also get you MGM Resorts. That company reporting fourth quarter adjusted EPS of 45 cents, more than double, or I should say almost double what analysts had been anticipating, which was a 27-cent EPS. Fourth quarter net revenue, $4.35 billion, also higher than anticipated. And when you look beneath the numbers, you look at Las Vegas Strip Resorts net revenue, that was down about 6% year over year, slightly missing estimates. And MGM China net revenue up about 3.7%, slightly higher than what was anticipated.
I'm just taking a look at Dutch Bros, guys. That stock is soaring in post-market. It beat for the fourth quarter on earnings as well as revenue. And then they also see their total full year 2025 revenue on the high end. That's also a beat. And their adjusted EBITDA earnings also a beat as well. That stock up significantly post-market.
Yeah, absolutely. I do want to go back to Robinhood here as we watch the shares tick higher here in the after-hours session. And we talk about the reliance on crypto revenue in that most recent quarter, about a third of its revenue growth. And the big question is, can you actually continue that pace going forward? Is that going to represent a third of their revenue for the first quarter, the second quarter, the third quarter on, or should we expect sort of a little bit of a receding in that contribution?
Hey, I want to go back to Cisco because it's up about 6% in the aftermarket. We mentioned that forecast for revenue, which is above what Street was expecting, driven by companies' increased spending on computing infrastructure for AI technology. This was a big question. They wanted to see, whether or not that spend is continuing to happen, and it looks like it does. We mentioned the company raising its fiscal 2025 target to over $56 billion, citing strong product orders and revenue growth, with sales rising 9% to $14 billion in the fiscal second quarter. So again, we've got Cisco shares up about 4.5% here at Romaine.
Reddit actually now reporting earnings. That's just crossing the wire. Those fourth quarter numbers looking good on the surface. 154.3 million in adjusted EBITDA, well above what the street was looking for of 128.7. ARPU in the quarter 4.21. The street was looking for 3.91. Here's your guidance, though. The company saying first quarter revenue will be in the range of 360 to 370 million. The low end of that range is above the average of street estimates here. The company also saying that it expects to see some continued strength on EBITDA as well, 80 to 90 million. That's the EBITDA forecast is giving for the first quarter. The street was looking on average for 72.3, though you see the shares significantly lower here in the after hours trade, down 12%. We're going to dive a little bit deeper in to see why the market reaction is what it is.
All right, perhaps a decliner for Tim tomorrow, and I know a gainer for me. Dutch Brothers still up about 25% in the aftermarket.
Dutch
Bros. Oh, sorry.
Yeah, sorry.
Is that how you say it?
Is it? I've never
Have you guys been?
We've just said we've never been.
I think we're in the wrong region.
Yeah, that's what I was saying.
Dutch Bros. All right, I stand corrected. All right. That's
all
a
right,
wrap.
bro.
All right. We'll see you guys tomorrow. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow.
And stick with us. A fuller breakdown of all the earnings crossing the wire, Reddit, Robinhood, Cisco, and everything in between, plus awaiting results out of Albemarle and a few others. A conversation up ahead, though, with a company that reported earlier in the day. Terry Duffy, the CEO of CME Group, going to be joining us next. This is The Close on Bloomberg.
The countdown countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Another interesting day on Wall Street. Of course, we started with that CPI report before the bell, and it really looked that was going to really take the wind out of the sails of whatever rally still existed. While stocks did finish the day in the red, they are well off the lows. Take a look at the S&P 500. Earlier in the session, it bounced off that 6,000 level, and you saw a lot of dip buyers come in, and it was a stair step higher. Not enough to push it back into the green, but certainly enough to keep it from that worst case scenario. Down 0.3% here on the day, which point out the NASDAQ indices managed to poke into the green towards the end of the day, but not everything escaped that downdraft coming off of that CPI report. Concerns about rates, concerns about FX that weighed on the banking sector, that weighed on real estate and REIT stocks, and a big part of the reason is 4.6 right now on a 10-year yield, with the expectation, Scarlett, that could go higher.
Yeah, and that would, of course, weigh on equities once again. Let's take a look at some of the day's big movers here, and we're going to start with a big decliner in the S&P 500. Wabtec losing about 9% on the day after the railroad equipment provider gave a full year forecast, I should say, that fell short of analyst estimates. You also have Upstart Holdings gaining about 32% on the day. This is an AI-focused lending company, a platform, and it's rallying to its highest in about 3 years, almost 3 years. Fourth quarter revenue at the company jumped 56%. Analysts called the results and the guidance a triumph. And finally, CME closing up about 3% at a record high. The futures and options exchange operator reported fourth quarter profit that topped analyst estimates. And for all of 2024, for the full year, CME saw volume growth across every single asset class.
Yeah, at one point on the day, of course, CME actually traded above its all-time high, which was set back in 2022. Here, investors liking what they heard today. The CEO of the CME Group joins us right now, Terry Duffy, for an exclusive interview. And Terry, it was a decent quarter. The general outlook that investors have seems to be bullish as well. Is this all about volatility in the market? Is that what's good for business right now?
Well, I mean, I'd say it's a little bit more than a decent quarter. I'd call it a really good quarter.
Okay.
We did a lot of interesting things, obviously, this past year, and then, of course, in Q4. So we're very pleased to be up 6%, quarter over quarter, and then we're up 10% year over year, as Scarlett was referencing. So is this all about volatility? I would say not. I think there's a whole host of factors that are going into it, and most of it, a lot of it is uncertainty. I mean, there are so many different things moving right now, whether it's geopolitical or others. People need to manage risk. You cited it earlier in your comments. Mm-hmm. The CPI number came out today. I think that caught some people off sides a little bit. We saw massive spikes in volume today, which we've been seeing in situations like this. So I think it's more fundamentally driven than just volatility driven, Roman.
Absolutely. And you're seeing a lot of people looking for, if not protection, at least hedges for not just the market volatility, Terry, but of course, I guess we could just call it the volatility out of Washington. And I am curious that whether you are anticipating maybe some of that vortex of what's coming out of Washington to die down at some point soon, or is that just kind of the normal we're going to have to live with, and for that matter, investors?
Well, I think it's something that, first of all, President Trump campaigned on this, so this has been well telegraphed, and we don't need to rehash that because everybody's already said that. So I think it should continue. I don't know why it wouldn't. He's got a lot on his agenda, and he appears to want to attack each and every part of it, which is exactly what he told the American people he's going to do. So I don't see this dying down anytime soon, Romaine, at all. So again, I think it's going to be very prudent to manage risk as we continue to move through the president's agenda over the next 24 months for sure.
When I look at the fourth quarter results, Terry, energy average daily volume increased 17% versus the same time last year. We know that there are tariff threats against Mexico and Canada in the last couple months, and I'm curious how that shows up in oil futures trading. It boosts volumes, yes, but does it create other ripple effects? Does it increase demand for more physical deliveries? Can you give us some more color on that?
Well, I don't know if it increases more demand for physical deliveries. I think what you saw more on the physical delivery side, Scarlett, was some of the advertised deliveries that we had against our gold contracts in New York. JP Morgan made an announcement that they were going to make a big delivery against our futures contract, which they did, around $4 billion. Historically, we don't see those type of deliveries in the marketplace. Normally about, 3, 4, 5, 6% of the markets that are deliverable come to delivery, but we saw a significant amount in the gold sector. So we didn't see as much much in the energy sector, so it didn't have an impact on deliveries. Again, the market is just fascinating when it comes to energy. We were sitting here on April 20th of 2020, and it was minus 37.50, and now we've been in a range between $70 and $80 a barrel for almost 2.5 years. So I'd say the market in general has acted fairly well.
Yeah, it certainly has, and that's showing up in your numbers. Terry, you're also seeing robust demand for your interest rate products. I'm curious as to how you're building off of that demand. Are there any new product offerings that you'll be introducing in the next 6 months, 1 year, that you can kind of give us a preview into?
Well, Scarlett, we'll be careful about what we're going to introduce or not introduce because we don't want all of our friends copying some of our ideas. But there are things that we have in the pipeline that we're looking at, and it doesn't necessarily have to just be new products and rates. It could be a whole new constituency of participants who's using those products. As I outlined today in my earnings call, we are now achieving $20 billion of margin efficiencies just in interest rates, and we're looking across our portfolio of all our asset classes of $60 billion a day in margin savings across all of our asset classes. So this is very enticing to a whole group of people who may have not used CME's products to manage risk. And as Romain and I were just talking about what's the new norm going to look like, I think a lot more people will be looking to take advantage of some of those efficiencies across CME's asset classes.
Terry, I do have to ask you just about your relationship, or at least the CME's relationship with the new administration. Obviously, a lot of familiar faces, at least on the finance and economic side of that, including, of course, one guy who could potentially be your nemesis, and Howard Lutnick, and some of the proposals that he has for moving some of I chuckle too, moving some of that Treasury clearing potentially to London.
I smiled, not chuckling.
Okay. All right.
Well, first, Secretary Lutnick, if he is voted on, I think this week, I think Thursday, they're talking about having a vote for him in the Senate. I assume that he'll have no issues getting approval to become the next Commerce Secretary. His objective as Commerce Secretary, as you know, Romain, is to do what's in the best interest of American business. It's not to do what's in the best interest of businesses outside of the United States. It's an America's first agenda. And the proposal that I've been arguing against, and I don't want to rehash it, but again, it's got nothing to do with London Clearing House being duly registered or money being kept where. It all has to do with the default and resolution authority that the London Clearing House falls under, which is the exclusive jurisdiction of the Bank of England. And I think under America's first agenda, the Commerce Secretary, the Treasury Secretary, who did say this in his hearing, and I'm assuming President Trump, who wants America's first, would not want to have that regulated or overseen outside of the United States of America. And again, the law is clear on this, on default and resolution. If in fact it's in the London Clearing House, it goes under the Bank of England, not the U.S. Treasury or any other agency here in the United States. That is my argument. So I'm assuming Mr. Lutnick will be very pro-America, and that is something that he will not pursue.
Are you confident that once he is confirmed and steps down from his role as CEO and chair of BGC, which of course is operating FMX, that removes any potential conflict of interest that he might have?
I don't think that's up for me to decide, Scarlett, what his conflicts of interest are or not. I don't have enough information to make that judgment call. I'm assuming he would not be in the position as Commerce Secretary if he has conflicts of interest. So I have confidence in the system that he will clear all conflicts if he has any.
All right, sounds good. Terry, really appreciate your joining us and taking the time to speak with us on the day of your fourth quarter results. Terry Duffy is CEO and chair of the CME Group. We do want to bring you some other breaking news. Albemarle reporting results, 2025 net sales forecast. So that's full year outlook, missing analyst estimates. Nevertheless, the stock is higher by 2.5% right now in after hours trading. Fourth quarter net sales coming in a little bit lighter as well at $1.23 billion, and fourth quarter adjusted EBITDA at $250.7 million. That was higher than anticipated.
A nice bid coming into Albemarle. Those shares up 2.5%. A nice bid also coming into Royal Caribbean. Of course, a buyback and a dividend boost will do that. The company approving a $1 billion buyback program and boosting its dividend by about 36% here. Those shares now up about 1.5%.
All right, and let's go back to Cisco, of course, which did report earlier on. Let's start with Cisco's move in the after-hours trade, up about 6%. It did boost its full-year profit outlook. It sees full-year revenue of $56 to $56.5 billion. Previously, it had anticipated $55.3 to $56.3 billion. We want to talk a little bit more about tech and earnings this earnings season, and for that, we bring in Lindsey Bell, Chief Market Strategist over at Clearnomics. Lindsey, great to see you.
Thanks for having me.
So we're starting to see a lot of these old legacy tech names like the Ciscos, like the IBMs, really talk about how AI and demand for AI-related products is giving their business a boost. Are we in the early innings of that, or is this about as much juice as they can squeeze out of the AI lemon?
No, I think we're in the early innings of that. And I think that's what you're starting to see, too, as you see this rotation from what I'm calling the tech sector into the communication services sector and some of these other different stocks like an IBM, which is in the tech sector. And what you're seeing is that there's more opportunity there. These are the second, potentially moving into the third derivatives of the AI opportunity. And so I think that investors are looking for the valuations that are better, the growth that are better as the hyperscalers, they start to slow their growth.
What about a name like NVIDIA? And I know we keep going back to the biggest one of them all, but they are reporting earnings in about a week and a half. And this idea that they stumbled about 2 weeks ago following the revelation of DeepSeek and are still down about 11% since that time. Have we seen the peak of NVIDIA?
I'm not so sure that we've seen the peak of NVIDIA. I think that there's major opportunity there, too, because like many other people have talked about the opportunity, just because another competitor comes out and is making this AI opportunity more cost effective and more efficient, that means there's more opportunity for others to get into the space, and it expands and it gives opportunity for more chips to be processed.
Is it easier to sort of value these companies that benefit? I mean, one of the reasons why the trade was so crowded last year, at least the reason that a lot of folks gave, was it was a lot easier to sort of model out what NVIDIA would make off this, or even a Microsoft or something. It was a lot harder to do that with those second-tier companies because, again, when you talk about second and third derivatives of it, it's a lot harder to see how you get there. Is it easier now?
No, I don't think it's gotten easier just yet. I think we have a lot to learn about how that's going to filter through to the system, and we haven't even seen it filter into earnings results. We've heard a lot of companies talk about AI in their earnings calls. In fact, this fourth quarter so far, the AI term has hit a new high on earnings calls. So it is definitely top of mind for CEOs, executives, and in board meetings. But the quantification of it has not yet been figured out, and that leads me to believe it hasn't fully, and the productivity of it hasn't fully hasn't filtered through to earnings.
One thing I found illuminating in a lot of these calls were the types of questions that analysts were asking about AI's potential contribution to the bottom line. And obviously there's a lot of idea about cost savings, the idea if you can eliminate certain employee roles and replace it with AI, that idea that becomes cost savings. But none of those companies seem to be willing to actually commit any real numbers to that just yet. And I do wonder if we are at least getting nearer to that phase where some of these companies will start to articulate what their own internal benefit is from this technology.
Yeah, and I think, too, that there's a benefit from your current employees being able to utilize AI to make their job easier and for themselves to become more productive. And so I think companies want to be careful about how they articulate that, too, because they want to be mindful of the employees that have worked for them and committed to and been loyal to them for so long. So I think I think there's just not a lot of information and certainty around what the potential benefit from a productivity perspective is from AI. But I think that companies are starting to see very early benefits, and I think this can ramp up quickly over time, and nobody's quite certain of what that's going to look like.
For so long, the Mag 7 and a big cohort of the tech sector were the growth story as well as the safety story, but they weren't value. Is there a cross-section of tech companies that do offer all three right now, growth, safety, and value?
Yeah, I think so. And but I don't know that investors are willing to accept that yet. So what we saw with earnings season so far, you look at the Mag 7, they're down about 3.5% since their earnings season kicked off at the end of January. And I think that these have become slow, steady Eddie growth companies, but they also have stronger balance sheets, stronger cash flows. There's also the conversation about the concentration of the overall index within these names, or even in the tech space in general. And I think what you're seeing is you're looking at, if you compare this now to back in the 2000 .com bubble, these are companies. The companies that are leading this now, they have margins that are twice as high as the operating margins were back in 2000. They also have better cash flows. They have better balance sheets. So I think that we have a completely different complexion of these companies now. And I do believe that some of these are turning into value-oriented opportunities.
So is that the argument against calling this a bubble?
Yeah, yes, I think that could be an argument against calling this a bubble, because I think they started the trend in AI, and the semiconductor stocks, right? And we're getting into the second and third derivatives of this. So it's going to filter through the entire system and benefit the overall economy and market in general.
All right, Lindsey, great stuff. Lindsey Bell, of course, the chief market strategist over at Clearnomics. A closer look at the tech trade, a closer look at those earnings out of Cisco as we continue to beat that earnings drum. A lot of companies have reported, and a lot of companies moving hard here in the after hours. Trade Desk and Reddit, two of the biggest decliners in the post market. Meanwhile, to the upside, Robinhood, that's among your top 5 gainers in the post market. A closer look at all 3 of those stocks when we come back after the break. This is The Close on Bloomberg. A wave of earnings crossing the Bloomberg wire. Let's get a roundup of some of the bigger movers out there. Bloomberg's Bailey Lipschultz, Jess Menton, Isabelle Lee standing by right now. We start with Bailey. Talk to me about advertising.
Romaine, it is bad. Trade Desk down more than 25%. This coming after fourth quarter revenue and adjusted EBITDA, both falling well short of what analysts were forecasting for. When your CEO in their opening statement on the press release talks about a disappointing fourth quarter and missing their own expectations, you're going to see a sea of red. This would be one of the worst first day after earnings moves for Trade Desk in a number of years. Also, their first quarter adjusted EBITDA forecast falling short of what analysts were looking for, as did revenue. So seeing some struggles popping up in the connected advertising space. We're watching shares of peer Roku, which are also trading incrementally lower after the bell. But again, 26% drop is not what we had been anticipating. This has been a stock that has been on a tear, but right now, if it opened here tomorrow morning, would be the lowest level since August, giving back a good chunk of about 6 months of gains. Jess, you also have some red on the screen.
Of course, and of course, this is also a meme stock that you've been watching pretty closely for almost a year since it went public. So Reddit, if you actually look at the SERP in the function in the terminal, the seats one-day implied move, actually nailed it, because it's implied a one-day move of about 15%. Now, obviously, we've only had a handful of quarters since it did go public in March of last year, but that stock's actually up 500% since it did debut, and actually is also up about 30% year to date. What happened here, it beat on the top and bottom lines. Even some of its guidance was better than expected, but unfortunately, it was that active user growth that missed expectations for the fourth quarter. The estimates were expected to be closer to 104 million, actually came in around 102 million. So that's why you're seeing that stock pressured. Bloomberg Intelligence had pointed out that that was something to watch because of the stiff competition when you're thinking about Meta as well as Alphabet. But obviously watching on the call if it says anything about this intercontinental exchange deal that they have as far as what it's going to have some of these products that it's partnering about here. But Isabelle, what are you keeping a close eye on?
We're keeping things different now because I'm seeing some green on the screen. Robinhood shares are edging higher by almost 10%. It's a beat across the board. Net revenue, transaction-based revenue, crypto revenue, assets under custody, and also net deposits. So the Stellar report really comes after a U.S. presidential election that really saw a huge crypto frenzy. We know that President Donald Trump has pledged to be the first pro-crypto president, and so far he has lived up to that. The company, this also marks the 5 sequential quarters of positive net income for Robinhood. So it's really astonishing because Robinhood started off as sort of like this meme company, but now it has grown into a $15 billion firm. And it even tried its hand into sports events contracts with Super Bowl directly in mind. And while regulators have challenged that, it just shows the nimbleness of the company. As for the stock, Robinhood is well into profit-taking zone after a breakout in September. We have Mizuho raising its price target to 65 for Robinhood. Back to you, Romaine and Scarlett.
All right. Thank you so much, Bloomberg's Isabelle Lee, Jess Menton, and Billy Lipschultz. And of course, Robinhood certainly benefiting from the increased interest in crypto trading. And I was looking at Bitcoin up about 4% so far this year, higher today as well, in contrast to almost every other asset class.
Yeah, but I always wonder about the sustainability of this. Obviously, they benefit from the crypto boom or mini boom, whatever you call it, and they obviously benefit from market volatility. But is that going to last?
It's lasted for this long. I mean, the swings have gotten much milder, right?
Yeah.
It's no longer seeing the big swings that we saw in previous years. But for now, it's they want to see actual policy being made.
Did you try to bet on the Super Bowl using the Robinhood
I did
app?
not, no.
Yeah.
Have you?
No, I don't gamble. But I was like, I mean, some of these companies, and Robinhood's been very articulate about this, they want to be kind of like the platform for everything finance related, but also, bet. They don't call it betting.
All
but
kinds of trading.
Trading, right, if you will. So it kind of seems like a natural evolution, assuming the regulators allow them to do it. But why not, right? I mean, they talk a lot about how much overlap there is between the type of people who would use, say, a DraftKings and the type of people who are on a Robinhood app. So why not bring the best of both worlds together?
Capture the zeitgeist, right?
It's like your chocolate is in my peanut butter.
There you go. All right, let's take a look at how markets closed on the day.
Are you old enough to get
good.
that reference?
I am. Of course I am. I'm like you. I'm the same age. All right, let's talk a little bit about what happened in trading today.
We're
lot
both
of
35, by the way.
Yeah, very, very young, 35. A lot of red there, and certainly across equities, although the damage was a lot worse earlier on, given the hot inflation reading we got this morning.
Yeah, it was kind of interesting to see how quickly these equities bounce back.
Yeah.
You did not necessarily see that bounce back, though, in yields in the Treasury space.
Right. 10-year yields moving up 8-9 basis points to 4.62%, and crude oil also down about 3% on the day. President Trump making a lot of comments about how he wants lower oil prices. He also had a phone call with Vladimir Putin. This is the close on Bloomberg.
I think it could grow meaningfully. It's probably not going to grow meaningfully in the short run, although our natural gas production, I think, is going to grow dramatically in the next 2 or 3 years. But if you look at 5 or 10 years, could America grow our oil production significantly? Absolutely.
That was U.S. Energy Secretary Chris Wright speaking exclusively with the close yesterday about the ambition to grow U.S. oil and gas production. You look at oil prices today, they closed at around session lows after President Trump said he spoke with Russia's Vladimir Putin, raising some hopes that risks to crude supplies in the region may soon ease. Joining us now for more on the intersection of policy, markets, and the economy is James Lucier. He is founding partner at Capital Alpha Partners, where he leads the firm's energy, environmental, and macro strategy practices. James, good to speak with you. The president is vocal about wanting more oil production to lower oil prices to A, reduce inflation at home, and B, pressure Russia into ending its war in Ukraine. This sounds pretty straightforward, but what would need to happen for this to play out the way he envisions?
Well, the fact is that Secretary Wright is correct. We do have the resource base to significantly increase oil and gas production over time. I think he's also correct that we can't do it right away. And there's also the problem that we're producing about as much as the market, the world market, can absorb right now. So in order to make sure that we have the option to maintain and even increase these high levels of production, we need to have visibility into the long-term regulatory policy of the U.S., and we need to have a high level of certainty that export infrastructure, including pipelines, LNG export terminals, and other similar types of line infrastructure can in fact be built. Given the resource base, if we can build the infrastructure, then we can certainly, given the correct market conditions, we can certainly do the production. But having consistency of policy over time, stepping away from the idea that we're going to phase out oil and gas production by some arbitrary deadline, and having uncertainty about what infrastructure gets built, the opposite. It would mean that we could not increase production the way the president is thinking about.
All right, and I just want to bring in some headlines that the president made just earlier. He did say that he will talk with Vladimir Putin by phone in Saudi Arabia for the first time as well. He also mentioned that he may sign reciprocal tariffs today or tomorrow morning. That's a possibility. And he did reiterate that we will do reciprocal tariffs. When it comes to tariffs, James, are tariffs on Mexico and Canada, the imports from those countries, as well as lower oil prices feasible? Are those compatible goals?
Well, that is a tough call, obviously, because we import so much oil from Canada in particular, about 60% of our oil imports. We import less from Mexico, but the fact is that U.S. Refineries are constructed for specific crude slates for Alberta crude or crude from Cantarell in Mexico. So that would be probably problematic for consumer prices, to say the least, if we have those reciprocal tariffs. On the other hand, can the president do these tariffs? I think he can. I've always been skeptical the president could do across-the-board tariffs on everyone. That's because of the delegation doctrine. Congress can't delegate the entirety of its tariff power to the president. But for a specific circumstance like a reciprocal tariff, I think that is something which would have a legal basis under IEEPA and perhaps other statutes. So yes, I think that the reciprocal proposal is something the president could move on.
Well, on that point, though, James, I mean, we talk about this idea of where Congress is, and I mean, some of the proposals, and I'm specifically speaking about the tariffs and the reciprocal tariffs, in theory, some of those proposals were supposed to go through Congress. Now, we know this is a president that is kind of doing a lot of things unilaterally and just waiting for it to all shake out. But is there any hope here that Congress would tamp down any potential proposals, any potential tariffs that he did put in place?
Well, I think already we're seeing the fact that Congress is absolutely unhappy with the idea of giant across-the-board tariffs on everything. I think Congress is more receptive to a narrow thing. Congress is more receptive to the idea of reciprocity. I do think Congress would put some pressure on the president to suspend these tariffs or hold them in abeyance or proceed for a little while on negotiations before we go in zapping other countries. Now, the good news is that there are countries like India which do have generally very high tariffs on the U.S., but in the case of Europe, the tariffs would be lower and there would be more opportunities to negotiate those down. So it depends country by country, but I think Congress is more comfortable with something targeted, narrow like this.
I am curious, too, and I just want to stick with Congress for a second. And we know that there is wiggle room for the executive branch to do things on trade and tariff that doesn't necessarily have to go through Congress. This president's also going to run up against a budget process that, based on the Constitution, has to go through Congress. And I am curious as to whether you think that he has the support, and I don't mean just amongst his own party, but he has the support broadly enough to push through some of those budget proposals, or should we expect a long, drawn-out fight that could push us back again to yet another sort of government shutdown?
Well, Romaine, this gets to the key question. What can President Trump get through the courts? I'll start with that first. As I've mentioned, there's a lot of doubt about exactly what tariff authority he has, given the fact that he's using statutes like IEEPA that have never been used for tariffs before. So you've got a president whose past legal challenges have been notorious, let's just put it mildly. And he's heading for a constitutional challenge over spending with regard to impoundment. So I'd say the key problem here is that President Trump is not going to get the deference from the courts on his tariffs that other presidents have gotten, precisely because he seems to be looking for constitutional challenges rather than somebody who is consistently protecting and upholding the Constitution of the U.S. So that's how I'd answer the question. I hope it made sense.
It did. I really appreciate you taking time for us. We've got to leave it there. James Lucier, founding partner over at Capital Alpha Partners, as we keep a focus on Washington. And of course, keep a focus on the economy. And the question of the day, Scarlett, is being single bad for the economy?
Bad for the U.S. economy in terms of GDP? In terms of what?
Well, we're going to find out. We have a conversation up ahead with Allison Schrager over at Bloomberg Opinion, who has some thoughts why all you single people are dragging us down. That's coming up next, right here on The Close.
We know what you think. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up, Ford CEO Jim Farley. He is in Washington today, meeting with lawmakers to warn them that Trump's proposed 25% tariffs on Canada and Mexico would, quote, blow a hole in the U.S. auto industry. He says tariffs would be devastating for the U.S. industry and provide a windfall for European and Asian automakers.
Yeah, I mean, we interviewed him last week on this program, and he talked a lot about this idea here that some of the foreign automakers, the ones that are based overseas, they actually have production facilities here, primarily because of past rules that sort of kind of forced their hand in it. So they're actually in a much better position that if these tariffs do go through, it's going to basically put a higher price tag, in theory, on competing cars from, say, a Ford or even a GM, maybe even a Stellantis. Meanwhile, Toyota and Honda, in theory, would be able to offer lower prices for similarly comparable cars.
Yeah, all kinds of estimates about how prices are going to rise for consumers.
Well, Farley down on Capitol Hill making his case. In the meantime, I'm keeping an eye on Mariah Carey.
Wait, it's not Christmas, though.
The singer is she is for every day of the year, Scarlet Food. The singer is among the 2025 nominees for the Rock and Roll Hall of Fame. Now, we should point out, don't get too caught up in the name Rock and Roll Hall of Fame. They take anybody from any genre. I'm not sure what they do. But, I mean, it's a pretty interesting list. I mean, it's like Joe Cocker, Billy Idol, Joy Division, and New Order, both going in
I'm for
on
that.
there. And Mariah Carey herself, who, is, in my opinion, the #1 diva in the world.
This is like a Gen X special, the names of the bands that you just listed.
Yeah.
Soundgarden's on there as well, Cyndi Lauper,
Oasis.
White Stripes, Oasis.
Remember we wanted to do something Oasis, and all our producers who are in their 20s were like, what's Oasis?
They had no idea what Oasis was,
I still hate
know.
them for that. Chubby Checker, by the way, came in as well.
Induction will be in LA this fall, so we'll see who actually makes it. But your money's on Mariah, clearly.
Outkast, Fish. I can keep going. Soundgarden, the White Stripes.
Gen X special, like I said.
Do we have anything else to do?
Third on the docket is Brian Moynihan. The Bank of America CEO says AI has a long way to go based on his own personal experience because he asked AI for a mortgage amortization schedule. This is what he does in his spare time, I guess. And he ended up getting a picture of a house. And the way he put it was, that's not right or wrong. It's just learning how to do this stuff.
I mean, look, all of us who've used some of these chat bots, or the ChatGPT or Claude or some of the other ones, we've been there. I haven't quite gotten the house, not that extreme, but we've gotten results that were a little kind of like
head scratchers.
What the heck is going on? All right, I'm going to add an honorable mention in there, and that actually has to do with Gary Steele. He's the president of Cisco. Well, he's no longer the president of Cisco. He's stepping down, apparently for an external CEO position. This is being announced by Cisco itself. Not quite clear where he's going, but we'll try to find that out and bring you that news as soon as we can get it. Meanwhile, we want to turn to Valentine's Day, Scarlett. You're actually dressed appropriately.
I know,
it's still
but
a
it's
couple
only
of days
Wednesday,
away.
2 days away.
But you're already in the spirit here, and well, that's an excuse to talk about whether love is translating to the U.S. economy. And if not, does America need to revive its stigma against being single? And in her latest piece, Allison Schrager, a Bloomberg Opinion columnist, says that the rise in singleness is creating what economists call a negative externality. But the question of whether singlehood needs to be stigmatized, and if so, depends on why more people are unpartnered in the first place. Pleased to say Allison joins us right now. You are, and I don't say this lightly, my favorite columnist, mainly because you take really important and it's not complex issues, and you kind of distill them down into fun ways. And this was a fun column because it's really not just so much about being single, but it's about just the kind of complexion of our society, how much things have changed. So let's start off. You are single, I'm told.
I am.
Are you a drag on the economy?
I am. I actually, as I think about it, I just might be.
Okay. So does getting married, would that resolve that drag?
To some degree, yeah. I mean, single people, less likely to have children or more likely to be single mothers. So, that's not good. And also, one of the things that's driving it is what economists call assortive mating, which doesn't sound romantic, but it kind of is, in that people hold out for that person who kind of is their one, who matches them, at least economically and education background. And that's also leading to more inequality.
Well, this is what I'm curious about, and I've heard about this and the idea. I mean, we've seen all the statistics. Folks are, especially certainly the younger generation, are getting married later in life, if at all. But I don't understand, just from an economist's perspective, if you have two individuals, let's say each one's making $100,000, is their contribution as single people that not more or the same as what it would be if they were married and had a $200,000 household income?
Well, it's more efficient, obviously, to have two people living together. I mean, single people also take up more space. I have my own apartment. If I were married, I mean, that'd be
nice. You have privacy. I miss those days.
Upstairs for me is a family of 4 in the same apartment, and it blows my mind.
So you use up a lot more resources as a single person.
Yes. I mean, there's a housing shortage in New York, and I am not helping.
So in order to help the economy become more efficient, to become more productive, all the single people should get married. And we've seen this before in the past. You point to post-World War II or during World War II, what happened in Europe, and you said that overall, from an economist's point of view, what happened there was good. What exactly happened?
I don't know if it was good, but effectively in interwar France, there was a huge social stigma. You had to be married if you were a woman. Like, you couldn't work. It had a big social stigma. So anyway, a lot of the men were killed in the war. Marriage rates did not go down. In fact, they went up. And male celibacy rates went way down because effectively women just married who was available, which were men outside their normal age range, or
women married men beneath them.
Yeah, or men who were just in the paper called not competitive in the dating market, which I guess just means, maybe not great. But, these marriages lasted. I don't know if they were happy, but they still managed to get married and fertility didn't fall. So it was largely then about stigma and partial economics.
So when I say it was good, meaning it was good for the economy in terms of the numbers and, what it showed overall about population growth, for instance, right?
Yeah, I'm not sure if the women would have been happier staying single. But, they still got married. They still had babies. The French economy grew.
The French economy. So what happens? I don't want to get too silly here, but if you're in multiple marriages, we were talking about Mariah Carey earlier. She's been married twice. Is that
divorce is inefficient?
Divorce is inefficient.
Yeah,
okay.
People lose a lot of money on divorce. It's very devastating financially and obviously emotionally. So we don't want that. But the thing is about assortative mating is people marrying people they're more compatible with also means divorce rates have been going down. So, there's good. That.
Yeah.
Have you gotten a lot of feedback on this column? Are people writing into you?
Yeah, one woman was like, we should have the stigma on men as well as women. But I think there's a stigma on men as well as women.
Is
being
there?
Single.
Yeah, there certainly is. And I'm curious, when we talk about the stigma, what even reignites that stigma? There's no central driving force of it.
I don't think there is much of a stigma, and that might be the problem.
Yeah.
Not that I want a stigma, although I'd take a stigma over higher taxes if I had to choose.
Spoken like a true economist.
Yeah.
So sorry, one last question though. So this brings us back, circles us back. What exactly are you doing on Valentine's Day?
I actually have to go to a conference in Austin and have a conference dinner.
An economics conference, great.
Truly, we have come full circle. Bloomberg Opinion columnist Allison Schrager.
Not that I would expect anything else out of her, right? Yeah.
Allison, we look forward to the next column you'll write coming out of that conference.
All right, Allison Schrager, great column, really fun column there. Here, all right, stick with us. A lot more to cover here on the big program. And
let's talk about it now.
We're going to set you up for what's to watch over the next 24 hours. You know what, Scarlett? Let's not take a commercial break. How about that?
Yeah, let's go straight into what to watch for tomorrow.
We get a lot of earnings tomorrow as well, including in the pre-market out of a couple of interesting companies.
Deere, Crocs, so you've got industrial farm equipment and what foamy shoes for kids.
Yeah, so
Deere, adults doing gardening.
Deere and Crocs will be interesting. Crocs has been an interesting story, and obviously Deere is going to have some exposure to a lot of the geopolitical issues out there. A couple other ones that I'm interested in here too. You got Wendy's and Hertz. Both companies that are also going to potentially be affected by some of the chaos coming out of Washington.
Absolutely, and overnight we should also say Nissan and Honda are going to be reporting earnings. It's not clear what the state of their proposed merger is at this point.
After the market, after the bell tomorrow, we're going to get from Twilio, Applied Materials, DraftKings, Coinbase, Roku, Airbnb, Palo Alto Networks. Who you got?
I like Palo Alto Networks in terms of what they're going to tell us about the cybersecurity market.
We also get an update on PPI, of course, 24 hours after we got the CPI numbers, weekly jobless claims as well. And later tonight, Scarlett, something interesting taking place.
Yeah, the season finale of The Deal. Alex Rodriguez and Jason Kelly, they speak with Ted Leonsis, who's the founder of Monumental Sports and Entertainment. They own the Washington Capitals.
All right, definitely tune in for that. And please tune in tomorrow for The Close, 3 p.m. every day, right here on Bloomberg.